been doing it a long time. So that's
about 18 years.
Fantastic. So lovely having you chat to you. Take it away.
Hey, Braden. So we only had a chance to meet briefly the other night. So I think you get two very interesting perspectives from this. I think I come from very British. I've only really done business in the UK. Whereas Braden's bringing a very different perspective in the Americas. Where I'll freely say I think the US is light years ahead of us in terms of angel investing, being innovative, and actually moving quickly in fields. So I'm going to be really interested to see what Braden said about some of the businesses he's been involved in, acquired and sold. So maybe Braden, do you want to kick us off and maybe just give us a 2-minute background to yourself? That would be useful.
Well, I have started maybe a half a dozen companies over the years. I've acquired probably 15-ish companies and invested in 40 or 50 companies. So I've sold some of my own companies, of course, acquired companies, so I've been on the other side of it. And then I've been involved in companies that I've invested in that have been acquired as well.
Awesome. And I guess for my background, I've worked in the UK sort of digital infrastructure sector, so primarily data centers, hosting and cloud businesses, as you call it now, primarily on the managed services side. And predominantly have been on the sell side. I've done a few acquisitions as part of roll-ups for private equity, but it's been more interesting for me on the build side, get it to a certain stage, and then hopefully give it a good exit into something nice that will continue to grow as part of a larger business. So I guess we can throw it out to the audience for a few initial questions.
That's an AMA, but it really should be an AUA. It's Ask Us Anything.
Yeah, definitely.
So we're just going to sit here in silence until you ask us a question. Aha! It worked. Yes, sir. I don't know if there's another mic. Do we have another? Okay. Oh, here comes a mic.
Sorry. I was chatting to the customers. It's shame on me.
Hi, thanks, guys. So I think my question is just, when you have your business up and running and your early stages and you see some success, what actually drives you to sell? I suppose it's a question around timing.
Money. Next question. So the question is, what drives us to sell?
Yes.
I think it's different for everyone, right? Everyone has their own reasons to sell. Some people want to retire. Some people are bored of the thing they're doing and they want to move on to the next thing. Some people have to sell. Some people get divorced. I mean, it's all kinds of reasons. I think the best reason is to take your chips off the table, to take your profits, and then start something new. At least that's what I would want to do. But some people's lifestyle. Some people don't sell because they don't know what else they would do. They've been doing this same thing for 30 years and they'd be bored. For me, I want to go do the next thing because I've done this thing for a while and I'm bored of it and there's no more challenge. And so I'd rather take that money and start something new and have a new challenge. So that's my reason, but I think it's different for everyone.
Yeah, I think there's quite a variety of reasons that drive that decision. Some of it can be external market factors. So, for one of the businesses we sold in 2011, we were running what you'd class now as a cloud company, but Amazon and AWS had really started to take off. And it was a factor of, hang on, are they just going to eat the whole market? They've got bigger pockets and deeper pockets than us. We're on an upward trajectory. Private equity started to have a little look at this industry. So actually, is this the perfect time for us to be able to take our chips off the table and de-risk ourselves? There's been other aspects where I've had external shareholders, reaching an age and they're already retired, but they're now getting to the point of going, actually, we just don't want to be involved in any businesses anymore. And have been able to structure a very solid exit path for them, whether that's doing a management buyout, or going, actually, this is the timing for us as a management team to also exit, because that's another key thing. Making sure that both the shareholders and the management team, depending on the size of the business, are aligned and who wants to potentially stay in and roll the dice over, or, as Braden said, take your chips fully off the table. I've never been in the position of being in a forced sale yet. I've been, I guess, fortunate in that regard of not having to go, okay, we've just got to sell this business. If we don't sell the business, it's just going to carry on in decline. I think we're probably very fortunate that the majority of us in this room are working in technology, and we're still in some very strong tailwinds supporting the growth of the industry. Okay, it's obviously different from the earlier mid-2000s where you didn't need a sales team, you just literally had to pick up the phone and take orders. But I think there's other industries where I see and observe some of the challenges of decline, and the multiples they're getting are, well, not even multiples. It's sort of right, take the liability off their hands.
Yeah, there was a company I sold about 8 years ago, and it just felt like the industry was changing in that private equity was coming in and kind of rolling up all the companies. So there was an opportunity to get the best multiple at that time because the PE companies were kind of fighting for deals. And then projecting beyond that, I thought that margins were going to shrink after that, because then you've got all these deep-pocketed PE companies competing against one another as the industry consolidated. So I didn't really want to be in that position, and I had an opportunity now to get kind of a higher multiple, and so I cashed out. And so it was an opportunity, but at the same time, I thought it would be harder to be profitable going forward. So it wasn't exactly forced. But the timing was just right. Everything kind of gelled. But it's really different for everyone. Yeah, but if you plan to sell, begin with the end in mind, right? So if the objective is, if you take on investors, right, you're going to have to sell at some point so they can make their ROI. But always know where you're going, because if you don't know where you're going, any path will get you there. Right. So if you plan to sell, keep your books clean. Keep as much profits in the company. Don't start taking profits and doing different things with them, because you can save on taxes. You want the company as profitable as possible for as long as possible, and you'll get the best multiple. So. There's a question here. Oh, he's already got a mic. He beat you to it. Manmeet?
Yes. So Manmeet from DomainX India. I have 3 questions actually. First, do you only invest in domain name companies? Second,
I'm sorry, do I only invest in domain companies?
yes.
Yeah. No.
Okay. Second question, I see you're wearing Adam t-shirt. You do invest in domain companies though?
Yes.
Okay. How many investments do you currently have, both of you actually, in domain name companies, which are currently active? And is there a set criteria that you look at while investing, or you look at the broader picture somehow? Thank you.
So I'm not invested in any just pure play domain companies. There's a few hosting and cloud businesses that I've got small equity in. And obviously domains are part of those businesses, but it's generally not the core of the service. It's more a supporting service. Overall investments, I think I've got minorities in about 15 companies at the present time. And that's just been accumulated over a number of years. There's opportunity in the market, either sometimes through customers, and that can be a great place to be when you're running a business and you've got a customer that seems to be up and coming, and you're like, well, actually, I want to support your growth. You're going to help my business grow as well, and you can provide some advice and guidance as well. And that covers things from, in the tech space, from software, sort of infrastructure services, a little bit on the actual physical fiber in the ground as well. So it's quite varied, but it's about being able to translate some of the skill set you've got and provide that advice and guidance, and not necessarily do it this way, but here's a path I've been down before and it was the wrong path. So don't do that. Do your own path, but don't do this one.
I invest in primarily tech companies that are non-domain related, SaaS, big data, AI, that sort of thing. I have maybe investments in 40 companies probably currently active. And then I own a handful of companies which are oftentimes roll-ups. So I've bought out competitors over the years as well. As far as domain-related companies, Atom, I'm invested in. Hilco Digital Assets, which is a domain brokerage. NameBlock, I'm invested in. Desktop.com is not domain related, but the founder is Rolf from .global. Once upon a time, I had an investment in Epic, but that turned into a dumpster fire. So, but that was about 12 years ago, long, and I lost my entire investment. So that's mostly gone. I'm told there's some shreds of things left, but I've written it off. Domain Insight?
Yeah.
Sorry.
So I read it last night that somebody picked up Epic Assets and a new ownership has popped up.
Not that I've heard. I mean, it's a registered agent, I think was the name of the buyer, but I wasn't involved in any of that, so I don't know anything about them. But
Yeah,
I think that there's a representative from.
Christopher Ambler.
I saw a tweet this morning from him, but I think he's a registered agent as far as I know, but I'm not sure.
Yeah, thank you.
Yeah, well, I have no interest in that because those assets were sold off. So
Okay, thanks.
I think there's just one other part to the question there about decisions on investment as well. And we were having a little discussion the other night where I think, back to this point about the American mindset compared to potentially the British mindset about what stage of investment and the company's journey. Where I'm very much a post-revenue. It doesn't have to have free cash flow, but I have to see a very clear path to that, and there has to be customer revenue there already. Whereas I think you were saying you're a bit more adventurous.
So I'm an angel investor. It's my own money. I'm typically first money in or very close to. It's among the first money. It could be pre-revenue. Sometimes it's post, but rarely do I get in at an A round. For me, it's just that the valuation has gone up too high at that point. I'd rather take a higher risk. However, I do a lot of follow-on rounds. So if I get in early and then the VCs come in the A round, then I'll maintain. I take what's called pro rata, so that I can maintain my equity percentage, so that I'm allowed to contractually continue putting money in at whatever the current valuation is, so I can maintain the amount of equity that I have. So I will continue and I might invest in a company 5, 6, 7, 8 times until maybe it's too expensive, or my pro rata would be $1 million, or the company gets sold at that point. So, but I usually stay in because then it's de-risked.
I've got a question regarding acquisitions and the importance of due diligence. So for Steve and also for Brandon, what advice do you give to people here regarding due diligence, and perhaps share some experiences of bad due diligence?
You want to start and I'll think?
Yeah, sure. Well, I think I've seen it done well. There's only one time where I've seen it done badly, and I wasn't too close to it at the time, unfortunately. So going in with a structured process is kind of important. And I probably have a list now of between 150 and 200 questions that I want answered about the business. At the early stage, don't send that list over. Like, you're interested in maybe 5 or 6 things. You want to see the health of the books. You want to see a bit about customer base and customer profile around concentration risk. You want to see what their growth has been and their potential growth. So you want to see they've actually got some structure in place to manage that. I want to understand a bit about the management team. So if it's a founder CEO, for example, that's looking to exit the business, is he the central focal point? Has he built a management team below him so that when he does exit, actually you can bring that management team over and see an integration path. And finally, is there any potential synergies at the very high level? Could you buy the assets on its own without buying the whole organization, and just flip that into your own business and actually get the efficiencies of scale? Or is it niche expertise that you're buying in? Then from that, there's if that starts to get interesting, it then becomes a lot more detailed and going through a lot more of the financials, the legals. Tax implications here in the UK are an absolute nightmare on acquisitions. I suspect it's probably similar in the US. And then making sure that actually there is a deal flow that would work. Is your timing going to work with their timing? Is it back to that point about selling? Could be a health reason. So there you go. You've got an immediate right. This is like a time hard stop deadline on buying this business. And if you're going to be paying out 10 million, actually, do you have the free cash? Are you able to get that cash quickly? And how are you going to leverage any cash of your own to do that acquisition?
Oftentimes, my acquisitions have been of competitors, and so there was history already. We knew what they were doing. We had inside information. When I've acquired companies that was in a different industry, and I had to really do some diligence on it, I have found that talking to employees, and then more importantly, speaking to vendors, because employees may lie, but vendors don't. Right? So vendors will tell you exactly what's happening, whether they're. I have found companies that it looks good on the books, and then I talk to the vendors, and I find out they owe all the vendors a lot of money, and they haven't paid in 6 months. I bought a company many years ago, domain related. It was sciencefiction.com. It was a developed site. I unfortunately still own it. And the seller lied about everything and fabricated all the books. And I trusted him. It wasn't a big purchase, and I didn't do as much due diligence as I should have. And once I started talking to vendors, I discovered he wasn't paying any of his bills. And it was not what I thought it was going to be. And I didn't end up suing him. I could have, but I figured I would get a judgment that I couldn't collect. So there's no sense in spending money getting a judgment you can't enforce. So the going back to your original question is vendors is what I've discovered, because you can look at books and books can be fabricated and people lie, but vendors don't.
I thought I'd just touch on the one that went wrong as well, or wasn't ideal. So this was buying the assets and customers out of a company that was in administration. It was fairly sizable, but it had been done as literally a desktop and spreadsheet diligence exercise. And this is for, probably 60 million sterling revenue. It's kind of a significant sum, but because it was in administration, there's a lot of back and forth around it. And the administrators, didn't want to expose the employees or the vendors or some specific details. So on paper, it looks like a great deal, but actually when we were sent in afterwards to kick the tires and actually really look at this business, we were like, holy crap, this is going to take a lot of capital to put right. And that was one of the unexpected things, because it's data centers and that sort of sector. It was going to be, right, well, we've got this at a great deal for the revenue, and we can see a path to profitability, so it wouldn't fall into administration again. But to get it there, we're going to have to put in between 10 and 15 million of capital on top of the purchase price, which was kind of unexpected at the time.
Guys, you probably, for a good deal, are competing with a lot of other investors. Apart from money, what is your pitch of what you bring to that company, apart from finance, so they choose you?
Yeah, so I try to be, it's what we call smart money, right? There's smart money and dumb money. And dumb money is just somebody writes a check and then they can't contribute anything beyond their money. But smart money is somebody that experience, they can be an advisor, or they have contacts with other people in the industry. So I try to be smart money because, for one, it's I'm a better investor. I know the industry. I know what they're doing. I can be helpful. I can help the company grow beyond just basic business principles. But So if it's an industry that I'm familiar with, then I'm more likely to be able to invest versus somebody that's not, unless they're writing a much bigger check. But it's more interesting to me if I can participate. So that's my objective when I invest. Not always. Sometimes I invest in something just because it's a good deal, but I try to invest in things that I like.
I think there's a fit, cultural fit, which it's a really difficult thing to pin down. On the face of it, you might think actually this is going to be a great addition to the overall culture. The cultures of the businesses are quite similar. There might be a good revenue mix between the two. One of the acquired companies does XYZ service to a much higher level, and you've got 10% of your revenues in that space. So actually, it's quite accretive in that regard. Which then goes to Braden's point around, okay, how the management team is going to work and fit together. Can you see a future journey for that acquisition in the sum of the parts being greater, which is always difficult. You can look at the financials and tick a load of boxes and go, cool, that makes financial sense. But is that future partnership between the organizations actually going to deliver a growth strategy? And particularly if you've got two, so this is in the early phase of doing PE roll-ups. The first platform you acquire is kind of the key, and then the second one is even more important because you'll probably be acquiring two that are at similar sizes. Right, what are you going to be doing around the cultural integration of the businesses? What are you doing around the brand? Because the first one will probably generally feel, well, we were acquired first, so we're the stronger, we're the better. But if you've got two organizations that are similar in size, similar in revenues, similar in profitability, that's where you start seeing some friction, which isn't necessarily a bad thing, particularly for management teams. I like professional tension in management teams. It has to be respectful, but you actually want the management teams to be challenging each other and be looking and questioning and going, well, actually, is that the right direction for the business? Is that the right decision we're making on a day-to-day basis without having to involve the executive team or any of the shareholders in those discussions? Because you want a business to be a bit like a flywheel. You put your energy in at the start, and then you want the management team to take over and keep that energy going, and you can just keep it flowing while you're looking at other acquisitions, diversification in the market, listening to the customers and getting their feedback on what direction the company should be taking. Customers are great for that. They'll be very honest with you about what their plans are. And if you speak to 100 customers and 50 of them are all saying, oh yeah, this is probably going to be the technology we're going to need in 2 years' time, start having a think about, right, is there an acquisition we can do to accelerate our position there? Is there some research and development we can be doing to be ahead of the curve slightly so that we have a service to market and expertise in the next 12 to 18 months? So there's quite a few nuanced factors there.
There's a company that I sold about a year and a half ago. Well, it was a merger. So I merged with another company, but the other company was 4 or 5 times the size. And but for all intents and purposes, I negotiated it as if it was a sale because my compensation was shares in this new combined entity. And this bigger company had bigger brands and more expertise than what we brought to the table. And so I had to take kind of a back seat, which is, I didn't have an ego in it. It was whatever's going to work best for the company. And they took some of our products and they changed the brand. And my staff didn't like it because they were so proud of our brand and what we had built. But I said, look, it's whatever's best for the company, right? And so if it makes sense to take these products and change the brand on it, if it's going to sell better, then let's do that. And that was the case. It was just a stronger brand on our products. And so we took kind of a back seat, and some of our staff didn't like it because they couldn't check their egos at the door and they left. But ultimately, the company is better off for it. So you just kind of have to learn your role and determine what's best for the company.
Yep, thank you. I don't want to just ask all the questions, but...
Last question? Yeah.
Do you have a preferred framework for finding buyers, or do you find, because something we experience, we get approached pretty often to get acquired just by email through LinkedIn probably. So when you have what is obviously a good company that is attracted to sell, do you have a framework for finding that buyer, or you find you naturally just get offers anyway, routinely?
Yeah, well, I think it's important. There's an important distinction between selling your company and someone buying your company, right? You don't want to go out there and sell the company, you want to be acquired. And the reason is you're in a better negotiating position if you're being acquired versus you going out and selling, right? So it's a perspective thing. So if buyers approach you and then you have an offer, you can then shop that offer unless you have a no shop clause in your LOI. But it's going to be your competitors, right? It's going to be a strategic buyer. It's always best to sell to a strategic buyer, whether it's a competitor or otherwise, because you'll get a better multiple. Because someone that's buying it and they're going to take all of your overhead, they're going to be operating on probably the same margins that you've been operating. However, if it's a bigger company, if it's a competitor and there's economies of scale, then it's different metrics and the multiples will change. So you'll get more money. So I'm always looking for somebody that's buying strategically as opposed to someone that just wants to buy a lifestyle business.
I think the intermediaries sometimes get a bad rap. Having someone who specializes in helping you structure the sale and knows the market and are doing 20, 30, 40, 50, 60 deals a year and are very slick at it. There's generally someone you'll probably know in the sector that's they've done 40 deals in the past 5 years, which is exactly your sort of business. Make sure you're having the conversation with them once a year. They'll probably wine and dine you and make you feel warm and fuzzy, but see past that, actually get to know them, because when the time does come, and people will approach them quite a lot of the time to say, right, who have you got on the books? Who's looking to sell? Who might sell? Those guys actually can be, worth the few percent that you end up paying them. They also, one of the biggest things is it's a lot of the time your baby. You've built it, you've grown it, and it can sometimes be hard to be impartial and go, actually, these are there's the freckle, and oh yeah, no, broke your arm slightly a few years ago, so there's a little wobble there. They'll bring that realism to you as well, and also help you with the story about the position the business is in, and make sure that you are in a good position, so that everything lines up. And again, they'll be able to do the nice teasers in the market for you as well, which is always helpful because, again, they've got a contact book which is up to date and fresh. Whereas if you've been focused on operating your business, growing it, running it, you're not necessarily focused in having all those conversations because it can be a distraction.
Okay. No. I know you said 2 minutes, like 8 minutes ago.
Exactly. But Braden and Jim, thank you very much. A round of applause for Braden and Jim. Very, very valuable and fantastic insights and great questions, people, as well. Thank you very much.